Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Tellurian stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Tellurian delivers natural gas to customers all around the world. It is developing a portfolio of natural gas production, LNG marketing, and infrastructure assets that includes an LNG terminal facility. LNG stands for liquefied natural gas. That facility is called Driftwood Terminal. In the company's 12/31 press release, they mentioned they completed Driftwood LNG Phase 1 sales and purchase agreements, totaling 9 million tons per annum. They also mentioned it drilled and put into production 4 new Haynesville-operated natural gas wells. This increases their developed reserves by 51 billion cubic feet. The company produced 14.3 billion cubic feet of natural gas in 2021. It has natural gas assets of 11,060 net acres and interests in 78 producing wells. Their estimated reserves are 323 billion cubic feet of natural gas. The company is headquartered in Houston, Texas, and was founded in 2016. The ticker trades on the New York Stock Exchange, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a mid-cap company, 3 billion market cap. They're trading at $5.84 a share, and they have 518 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have negative free cash flow every year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is the sales for the company, and that grows a lot each year from 10 million to 30 million to 40 million to 70 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grew a lot from 2.6 million to 23 million. Below that is their operating expenses. Payroll is their main operating expense. Gross profit minus operating expenses gives you your operating income, which is negative every year. They spent 9 million of interest on their debt, which was a lot less than 2020 of 43 million. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example of something in this category is an asset impairment. Then you have your pre-tax income. They don't really pay any taxes yet since they're not making any money. And the bottom line of the income statement is their net income, which is negative every year. This is the company's income statement from their 10K. And this gives us a little more info than Yahoo Finance. Their revenue from natural gas sales is 51 million. Liquefied natural gas sales is 20 million. And it's growing in both categories. It almost doubled from 2020. The cost of sales is 36 million. This includes all the expenses from pulling and delivering the natural gas. Then you have development expenses. Since they're an upstream company, they have to identify locations where there is natural gas, then physically pull it from that location. So they're going to always have development costs. 11.5 million in depreciation, depletion, and amortization. 86 million of general and administrative expenses. Since they're not bringing in much revenue at this point, their operating expenses are a lot higher than their revenue. So they have negative operating income each year. But as they scale and grow, they'll eventually hit break even, then become profitable. They spent a lot less interest on their debt than prior years. And of course, they have negative net income each year. They had the best EPS in 2021, negative 28 cents. Last year was negative 79 cents. Before it was negative 69 cents. And they have been increasing their shares outstanding each year from 218 million to 267 million to 407 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. Since they're an upstream company, they're always going to spend a lot on CapEx. They spent 43 million in 2021. Their most was in 2019 at 48 million. But I expect the CapEx to get much larger in the future. Operating cash flow minus CapEx gives you your free cash flow. Since they have negative free cash flow each year, they're running their business on equity and debt. It looks like they're trying to pay down most of their debt. In 2020 and 2021, they paid down a lot of their debt. So they're mainly running their business on equity. They raised $133 million in 2018, $100 million in 2020, and $420 million in 2021. Every time a company issues common stock, it increases the shares outstanding and makes your shares less valuable. This is their operating cash flow section from their 10K. And the way you calculate operating cash flow, you start with your net loss. That was negative $115 million. Then you add back depreciation, depletion, and amortization of $11.5 million. You add back another $3 million of amortization, $6 million of stock-based compensation. Then you adjust for changes in working capital. That was positive $41 million. So they lost $62 million of cash flow in 2021. Last year they lost $70 million. Before that they lost $113 million. The reason they passed through a big loss in 2020, a net income of negative $210 million, was this large asset impairment of $81 million. That's a non-cash item. That's why we add it back here. This blue line is the company's revenue since 2016. The orange line is their operating cash flows. Their revenue is finally growing. It's still small, but it gives investors hope for the future. And of course they have negative operating cash flow since their revenue is so low. The forecast is for their revenue to grow exponentially the next few years, while their operating cash flow to remain negative through 2024. In my model, I have negative free cash flow up through 2024. It's positive for the first time in 2025. This is their investing and financing sections. In their investing section, they spent $32 million in acquisitions of natural gas properties. Last year it was $1.3 million. Before that it was $45 million. They spent $15 million in engineering services and $10 million in purchases of property and equipment. So in their investing section, they had a cash outflow of $58 million. In their financing section, they added $420 million of common stock. They added $56 million of debt. They paid down $120 million of debt. They added $8.2 million of warrants. Warrants are like long-dated options. So in their financing section, they had a cash inflow of $345 million. Last year was a cash inflow of $85 million. This is the equity section on their 12/31 balance sheet. They have $418 million of equity. They issue common and preferred stock. They raised $1.3 billion from issuing stock, and they lost $930 million from running their business. Let's look at the capital structure. They have $418 million of equity, $56 million of debt. They're 88% equity, 12% debt. And they could pay off all the debt with the cash on their balance sheet and still have $250 million of cash left over. This blue line is their equity balance since 2016. So you can see it went up a lot in 2018, then it came back down, and it's currently at its highest point ever. It also has lots of cash on their balance sheet and not too much debt. Up to this point, it seems like a pretty well-run business. I gave them the highest whack on Finbox, 8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $6.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.7 billion. We divide that by 518 million shares. And we get a calculated stock price of $9. They're trading at $6, so they're trading at a 35% discount. It's a buy according to the model. The forecast is for their revenue to hit $1.39 billion by the end of 2024. I grew their revenue from 2021 to 2024, so it would hit that point. And then I just assumed a 20% growth from 2024 to 2025. The average company in their industry converts 20% of their revenue into free cash flow. So I multiply their 2025 revenue by 20%. That's how I got their future free cash flows. And I assumed they would have negative free cash flow before that point. The website Simply Wall Street values the company at $9. They're saying it's 34% undervalued. Two analysts priced this stock. One is $6 and another $8. When the stock started trading, it was over $10 initially. And this stock fell below $1 during the COVID crash. It hasn't moved up a lot since then, but it's kind of been all over the place, up and down. Since they're not profitable, investors have to look towards the future. And when the company comes out with good news, the stock price goes up. And if there's no news for a while, then there's usually a sell-off. If you invested in the S&P 500 when this stock IPO'd, you'd be up 94%. If you invest in this stock, you'd be down 48%. This is a really volatile stock. It has a beta over 2, so the stock moves more than 2 times the market. It's up 163% in the past 52 weeks. While the S&P is up 14%, the 52-week low is $1.62. The high is $5.88. And the stock is on a major uptick, trading above its 50-day and 200-day moving average. This is a really popular stock. Over 20 million shares are traded each day. Of the 518 million shares outstanding, 427 million are on float. 34% are held by institutions, and it has a high short percentage. Over 16% of the shares are shorted. Their employee count peaked at 175 a couple years ago, but they're currently at 107 employees. There seems to be a lot of insider buying and selling the past year. 236,000 shares have been bought, but over 11 million shares have been sold. Here's a list of all the people or companies that bought and sold the past 12 months, the date, the shares, and the price. The company Total Energies did most of the selling. I did a video on Total Energies recently. They're one of the 7 super major oil and gas companies. They're located in France. The general public owns 48% of the company, institutions 34%, insiders 14%, and public companies 4%. The founder and CEO of the company owns 5.5% of the stock, then State Street, BlackRock, Vanguard, and Total Energies. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is a bit high at 43. Price to book is 7.2. That's stock price over book value per share. Let's look at their non-current assets. 150 million of PP&E, 110 million of deferred engineering costs. Of course, all these engineering costs are related to the Driftwood terminal. And other non-current assets of 34 million. Let's look at their non-current liabilities. 54 million of debt and 61 million of other. They have a high current ratio of 3.7. They can easily cover their current liabilities with their current assets, and a quick ratio of 3.7. Let's look at their current assets. 300 million of cash, 9.3 million of accounts receivables. This is how much money's owed to them, and 13 million of prepaid expenses. Here's a breakdown of that 13 million of prepaid expenses and other current assets. It's 600 million of prepaid expenses. This is when a company makes an advance payment for a product or service they're going to receive in the future. They put down a deposit of 3.6 million, 8.7 million of derivatives. Let's look at their current liabilities. 3 million of accounts payable. This is how much money they owe others. 86 million of accrued and other liabilities. Here's a breakdown of the 86 million. 26 million of project development activities, 50 million of payroll and compensation, 1 million of accrued taxes, 3 million of professional services. They owe 2.3 million on their leases and 3 million of other. Even though they lost 100 million of free cash flow in 2021, they have over 200 million of working capital. So it looks like they should have enough money to get through the next 12 months without needing to add any more debt or equity. The best way to look at ratios is to compare them to companies in the same industry. There are 86 companies in the same industry as Tellurian. And Tellurian is a pretty young company, and they recently started generating revenue, so they don't have good ratios. All their price multiples are worse than average. Their market cap ranks 41st of the 86 companies. The average is 9 billion, they have 3 billion. But their revenue is growing a lot. It's easy to have big jumps in revenue when it's so small. So to summarize, I have them trading at a 35% discount. But it's really difficult to value a company that's just starting to build out their infrastructure and get their contracts in place. There seems to be a lot of great potential with this company, and the fact that their leader is Sharif Suki, who has been really successful in this industry, is a great thing. I rank their free cash flows 1 out of 10, their revenue 4 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.